Hello everyone, my name is Yonko and I'm with the marketing team at Leverage Shares. Thank you for tuning in. Before we dive in, I have the pleasure to introducing our esteemed speaker for today's session. Violeta Todorova is a highly respected expert in the field of technical analysis with over 20 years of experience. She has received 2 awards of excellence for achieving the highest grade in Australia from the highly sought Capcom Professional Institute, where she has been invited to become a lecturer, underscoring her expertise and recognition in the field. Violeta's career took off following these accomplishments, and she has since been working with some of the best financial companies in Australia before joining Leverage Shares. Violeta will guide us through the key concepts of technical analysis, providing valuable insights that you can apply to your trading practices. This is an excellent opportunity to learn from one of the best in the industry. Please make sure to type your questions in the Q&A panel. Violeta will answer them at the end of the webinar. Please join me in welcoming Violeta Todorova. Violeta, we are excited to have you lead today's session. The stage is all yours.
Thank you for the introduction, Yonko, and a warm welcome to all of you joining us today for what marks the beginning of an exciting journey into the world of technical analysis. Today's webinar is the first one in a series that aim to equip you with the knowledge, tools, and techniques which can improve your trading experience. Today, we will focus on laying down the foundations of technical analysis, covering one of the most essential concepts like trends. Subsequent webinars in this series will dive deeper into more advanced techniques and strategies. Each session will build upon the knowledge gained in the previous one, creating a seamless progression. We'll cover a spectrum of topics, building trading and risk management strategies. So whether you're a seasoned trader looking to refine your skills or a newcomer eager to grasp the essentials, these webinars are designed to cater to all levels of experience. By the end of the series, I'm confident that you will be armed with valuable insights into how to use technical analysis and enhance your ability to make better trading decisions. I encourage you to actively participate in today's session, engage with the materials, and most importantly, ask questions, which I will address at the end of the webinar. Our goal is not just to share information, but to empower you with actionable knowledge that you can apply to your trading later on. So without further ado, let's dive into the presentation. Thank you again for joining us, and let's get started. The main focus of today's session is to introduce you to technical analysis, discussing the assumptions of technical analysis, and start building the basics, beginning with the Dow theory. Analysis of financial markets is often divided into 2 broad disciplines, fundamental and technical analysis, which are different approaches to the decision-making process in the context of trading or investing. Technical analysis approaches the decision-making process by examining the market for the financial instrument itself. The data from the market are primarily the price and volume. Technical analysis is not concerned with the value of the underlying instrument, but with how the forces of supply and demand are impacting upon its price. Technical analysis is therefore studies the changes in the level of supply and demand for the traded instrument directly, rather than indirectly via the factors affecting supply and demand for the underlying assets. There is no inherent conflict between fundamental and technical analysis, and they're widely considered complementary. The technical analysis discipline focuses on timing and primarily detecting when the balance of supply and demand changes. Fundamental analysis tells us should happen to prices, while the technical approach tries to tell us when the price change begins and ends. So, technical analysis is primarily used to assist with the timing of the decision-making process in investing, where an investor seeks four things. First, identify the beginning of a price trend, given that prices are not entirely random and move in trends for significant periods of time. Second, trade that trend. Third, identify the trend, the end of the trend. And fourth, exit, reverse the trade. So there are a few very important assumptions underlying technical analysis, which we will just discuss now. The way we look at markets is pretty much based on three important assumptions about the way all markets globally operate. First, the market price discounts everything that drives buyers and sellers. Second, prices are not entirely random and move in trends for significant periods of time. And third, human nature is constant, resulting in recurring behaviors in response to similar situations and thus generating repetition of certain price patterns. So let's have a look at the first assumption, price discounting everything. So market participants are driven by information that is available to them. They also act upon changes in their expectations of future developments. And finally, their investment decisions are driven by their hopes, fears, needs, and financial resources. Thus, technical analysis assumes that all factors that influence price have already impacted on price, meaning all of these influences are discounted into the current price. When information is published, some investors will conduct a superior analysis and have better insights into the evolving situation. For that reason, the price tends to be a leading indicator of published information. Then it is possible to trade the market based upon the pattern that market participants leave on the chart when they act upon the available information and their expectations. The second assumption is that price moves in trends. Many academics have argued that prices are random and that it is therefore impossible to profit from the study of price movements. This is based on a theory that markets are efficient and in the sense that information is discounted instantaneously. However, while some markets are relatively efficient, especially in the short term, there are many markets where price does not respond immediately to information. Instead, the perception of market participants tends to develop over time. The more efficient the market is, the more likely it is to move in sharp steps rather than a smooth trend. Some trends do exhibit a step-like pattern, and in some respects, these are the easiest trends to trade. However, more often than not, prices just adjust gradually. Only in very efficient markets where many people are watching as news come out, do prices adjust quickly. Fast adjustments also occur when an announcement is made that is news to everyone, such as takeover. Prices adjust gradually as more and more people hear the news, and also, very importantly, because everyone tends to have a different tolerance to risk. We all know that all markets move in trends at least some of the time. The assumptions that prices move in trends is critical to technical analysis. The identification of a trend in its early stages is very, very important to maximize profit by trading in the direction of that trend. Also, early identification of reversal of the trend is also essential in order to exit a trade with maximum profit or before incurring a loss. If prices didn't move in trends, there would be little point to technical analysis or, for that matter, any analysis at all, nor would be for professional traders to outperform the general market. And lastly, the third assumption of technical analysis is that human nature is constant. All market participants are generally driven by fear, greed, hope, and ego. We all tend to react the same way each time we encounter the same situation. While some reactions may cause us to learn new behaviors over time, this only applies to some market participants, in the sense that new participants are coming into the market all the time and more experienced ones are leaving the scene. New participants have a surprising ignorance of the way markets have acted in the past. The same mistakes are repeated by each generation of investors or traders. Even the same market participants will tend to repeat their past mistakes as they are gripped by fear, greed, hope, or ego. So these basic ideas lie behind the technical analysis ability to watch what is happening on a price chart, interpret how buyers and sellers are reacting to a situation, and to frame a view about the likely direction of prices. If something up to now is not clear, or if you need additional information, please feel free to ask a question. Use the Q&A feature on your screen and type it there. Before we move to the next chapter of the presentation, which is the Dow theory. So the Dow theory is widely attributed to Charles Dow and should be considered as more than an introduction to technical analysis, as it could be used by itself as a powerful way of looking at markets. The main objectives of the Dow theory are, first, to identify the three movements of markets on a price chart. Second, introduce you to the three phases of a bull or bear market to enable you to assess the state of the market. Third, determine the trend of a market from a chart. And fourth, identify when a market changes from a bull to a bear and vice versa. So let's start with the first point. The market has three phases. There are definitely three movements in the market, all of which may be in progress at the same time and in a different direction. The first and most important is the primary trend. The primary trend is the broad upward or downward movement known as bull or bear market, which usually lasts several years. The second movement, which could be quite deceptive, is the secondary reaction. The secondary reaction is an important decline in a primary bull market or a rally in a primary bear market. These reactions usually last from 3 weeks to several months. And the last and third movement is the daily fluctuations. So let's dive into what the primary movements are. The primary movements are the main focus of investors globally. They are the broad basic trend, generally known as a bull or bear market, extending over periods which have varied from less than a year to several years. The correct determination of the direction of this movement is the most important factor in successful trading. There is no known method of forecasting the extent or duration of a primary movement. A primary bull market is a broad upward movement interrupted by secondary reactions and averaging longer than 2 years. During this time, stock prices advance because of a demand created by both investment and speculative buying, caused by improving business conditions and increased speculative activity. A primary bear market is the long downward movement interrupted by important rallies. It is caused by various economic problems and does not terminate until stock prices have thoroughly discounted the worst that is apt to occur. Moving to the secondary movements. A secondary reaction is considered to be an important decline in a bear market or advance in a bear market. It usually lasts from 3 weeks to several months. The secondary reaction could retrace from 33 to 66% of the previous primary price movement. These reactions are frequently erroneously assumed to represent a change of primary trend because the first stage of a bull market must always coincide with a movement which might have proved to have been merely a secondary reaction in a bear market, the contra being after the peak has been attained in a bull market. A line is a price movement extending 2 to 3 weeks or longer, during which period the price moves within a range of approximately 5%. Such a move indicates either accumulation or distribution. Simultaneously, advances above the limits of the line indicate accumulation and predicts higher prices. Conversely, simultaneous decline below the line implies distribution and lower prices are likely to follow. And lastly, let's have a look at what the daily fluctuations are. Generally, they do not determine the overall trend, and these are the daily bars plotted on the chart. They are not important for determining the primary trend of the market and are often choppy and misleading. While the biggest profits are made by trading the primary and secondary movements, much of the modern technical analysis is concerned with short-term trading and seeks to analyze the daily fluctuations. The interest in the short-term movements has been driven by the emergence of many leveraged products over the past decade. Since these products deliver maximum results when traded in the short term, we will discuss in greater detail some short-term trading strategies in subsequent webinars, which produce pretty amazing results. Moving on, the primary movements have 3 phases. They're conceptually 3 phases to a primary movement, and these phases are the market behavior we are trying to detect by studying the charts. This is not a precise matter, though, with the start and finish of each phase blending into one another. So the first phase in a bull market is represented by reviving confidence in the future of business. The second one is the response of stock prices to the known improvement in corporate earnings. And the third phase is the period when speculation is rampant and inflation is apparent. This is a period when stocks rally on hopes and expectations. And the 3 phases for a bear market are: the first represents the abandonment of hopes upon which stocks were purchased at inflated prices. The second one reflects selling due to decreased business and earnings. And the third phase is caused by distressed selling of sound securities regardless of their values. The chart is not something we should look at as a tool divorced from what is happening in the market, and we should always try to map where in the business cycle we are. In order to determine the current phase, some of the relevant observations are that the average price earnings ratio for the entire market, the average dividend yield for the market reaction to news, the level of new capital raisings and IPOs, the apparent trend of the market, the level of interest in the markets by the main media like TVs and newspapers, What are the employment levels by brokers, consolidations in the financial industry or bankruptcies, inflation, employment, and so on. So before we continue with the rest of the materials, I just want to remind you again to feel free to send any questions you have in the tab. Determining the trends. Successive rallies penetrating preceding high points with ensuing declines terminating above preceding low points offer a bullish indication. This is the most important concept of the Dow theory and is absolutely fundamental to a large part of modern technical analysis. The concept of a trend is clearly visualized in the diagram. A bull trend starts when the price moves above the previous high after making a higher low. The bull trend ends when the price moves below the previous low after making a lower low. There are two important observations to be made from this diagram. First, we need a higher low and then a higher high before a bull trend can be said to be in place. And second, the emergence of a lower high and then a lower low ends the bull trend. This also allows us to be precise about where the bull market starts and ends. And I want you to notice on the diagram how every high and low is not validated until the price moves past the previous opposite swing. A new high validates the last low, and a new low validates the last high. So we cannot be sure of a new high until a new low is made, and a new low until a new high is made. Conversely, a failure of rallies to penetrate previous high points with ensuing declines carrying below former low points is bearish. A bear trend starts when the price moves below the previous low after making a lower high. A bear trend ends when the price moves above the previous high after making a higher low. Again, there are two important observations that we can make from this diagram. First, we need a lower high and then a lower low before a bear market is in place. And second, the emergence of a higher low and then a higher high ends that bear trend. These observations allows us to be precise about when a bear trend starts and ends. And again, notice how every low and high is not validated until the price moves past the previous opposite swing, which means a new low validates the last high and a new high validates the last low. So we cannot be sure of a new low until a new high is made and of a new high until a new low is made. So these definitions where a bull trend becomes a bear trend and so on seems very satisfying intellectually. However, the real world is not so tidy, and there exist other alternative endings to a trend. On this chart, we see a market crash, and at some point, the bull market ends. An intact bull trend has both highs and lows in the correct configuration. Once a low low forms on the chart, the bull trend is over and a new downtrend is in place. So there are two official endings of a market, of a bull market. A bull market ends when the price makes a lower low and moves below the last low, or if the market falls below the last low without forming a lower high. Let's have a look at another chart, this one. After a bear market, we see a strong market recovery. The bear market ends when the price rises above the last high. Again, we have two official endings of a downtrend, either when the price forms a higher low and moves above the last high, or if the price moves above the last high without forming a higher low. So this is a brief summary of the Dow theory, which gives us strict definitions when a bull and bear market begins and ends. This system is not infallible, and its successful use requires a serious study of technical analysis. And my aim is to equip you with all the tools technical analysis uses, so by the end of this series, you can employ them all and improve your trading results. And now that we have covered the Dow theory and have learned about the three types of market movements, let's have a look at the chart of Microsoft, where I labeled the beginning and the end of a primary bull trend. Primary trends are the most profitable to trade and are relatively easy to identify on a chart. If you look on the left-hand side of the chart, once the price moved above the last high, the price of Microsoft started trading in an uptrend. The uptrend has been in play while the sequence of higher highs and higher lows was intact. On the right-hand side, after the last higher high, the uptrend lost momentum and two lower highs have formed, warning investors that the uptrend is deteriorating. Once the last low of the uptrend was broken downwards, a new bear trend has started. Our aim here is to trade in the direction of the trend as soon as we identify it and close the position when the trend is over. So let's have a look now at the chart of Microsoft share price, which unfolded after the uptrend has ended, which we showed on the previous slide. So on this slide, we show the continuation of, we show how the downtrend unfolded after a top reversal has formed, and that downtrend has been intact right until the end of the chart because the sequence of lower lows and lower highs remained in place. Our aim, as soon as we identify on a chart that the trend is down, if we have the possibility to short Microsoft and hold the position until the end of the chart, as we didn't have a reversal of that downtrend. But if we zoom into the exact same chart of Microsoft, we can see much clearer the secondary reactions and the daily fluctuations. While the shorter time frame is the most difficult to identify, when trading products with leverage, such as our leverage shares ETP, this is the best time frame to be used. Most of our ETPs offer 3 times leverage and allow investors to be long and short the market. If we use the concepts of the Dow theory, which are the same for all the market's moves, short, medium, and long term, we have on this chart 6 short-term signals to buy and sell Microsoft shares, and I have highlighted them in blue. Please note that 5 of those signals were profitable and 1 incurred a small loss. These are the results based on the Dow theory itself, but in reality, no one trades using trend analysis by itself. From here, we will build on top of what we've learned today, which is a pretty basic concept more, and we will build some very accurate short-term trading strategies. I believe that only in the next few webinars you will know which trends to avoid in a chart and which ones to trade to maximize your return, but that's beyond the scope of today's presentation. We will touch on that in subsequent webinars. And as I said, by the end of the webinar series, you will be able to interpret the charts with ease and be able to preempt what's the next likely market move. And as we continue, we come to an end of our webinar. Let's wrap up the most important concepts that we have discussed today. So the four main things of today's webinars are, first, the three movements of markets and how we can identify them on a price chart. Second, the three phases of a bull or bear market and how we can assess the current market in terms of these phases. Third, we can determine the trend from a chart. And fourth, we can identify when a market changes from a bull to a bear and trade in the direction of the trend. And this is the end of our webinar today. Thank you very much again for your participation, and I hope you found those insights that I shared useful. For the more advanced attendees, please be patient and use today's material as a refreshment of what you already know until we get to the more advanced material. And let's not let today's learning end here. I encourage you all to continue exploring the topics we have discussed and applied those insights into your real trading.
Thanks everyone for tuning in. Thank you, Violeta, for sharing your knowledge with us. In case you have any questions, guys, please make sure to drop us a message at info@leverageshares.com. Connect with us on LinkedIn. We share a lot of insights on a daily basis. Tune into the next webinars on technical analysis with Violeta Todorova. Thank you, everybody.